Hello and welcome again to another episode in the webinar series Pitch. Our topic today is about financials. So here's what we will cover today. What should be included in the financial section of your case and your pitch that you are providing and delivering. And then we will talk about some tips and tricks and do's and don'ts. And as always, there will be a Q&A towards the end, and also an extended Q&A on the Facebook page for those who have some further questions or in between the webinars. More content and templates tools are available. So if you go to the YouTube channel or just follow the live link that we posted in the webinar sidebar here. Otherwise, you search in YouTube for /Wittigonia or just for Wittigonia, and then it will take you to the channel. Or you can join one of the briefing rooms in academywittigonia.com. And there's also a wealth of further opportunities to learn and check out new things. The webinar is designed for both people in the enterprise as well as entrepreneurs. So those of us who are starting up or scaling up a business, and an increasing number of people from the public sector also joining, especially in the area of transformation, innovation, jobs, etc. The replay will be made available on the YouTube channel. So watch, if you signed up via the webinar link, you will automatically receive the email when the replay is available. Otherwise, just check out the YouTube channel. So this is what I mentioned beforehand in WOA, the Wittigonia Online Academy. You will find several courses and briefing centers and learning opportunities, and you may want to watch out for this one or the one below, which says pitch, or the one below is shape growth. They're usually, we're posting some of the free stuff for you to follow up on. But the pitch training is also a great opportunity. We provide that both online as well as on-site, or as a blended version of it. So for whole teams who want to learn more about things, like with all the other courses. And there you find step-by-step guides, videos, tools, templates, and all that great stuff. The Facebook group that I mentioned before, if you go to Facebook and you type in shape growth in one word, then you can find the page which you can use to post comments or check out some of the previous work. So hi again, my name is Thomas Wittig. I'm the founder CEO of Wittigonia, and most of the time I work with companies on innovation, growth, and transformation topics. The topic today is all about financials, and specifically the financial section in your business case. And I will touch some interesting aspects of it, and also explain some do's and don'ts. Before we get started, please take a moment now and during the lecture, and please share and spread the word. Also, please, when you're watching this later on the YouTube channel, please take a moment and provide a comment or a rating with a thumbs up or thumbs down. I hope you like the content, and that way we know what to provide in future. Okay, so again, for those people who just joined, I saw that a couple of people just joined the webinar. This is the companion course. It's called Pitch. It's designed both for corporate and startups, and it's full of tips, tricks, and useful information. We are taking on people in waves, but you can sign up anytime. And there's a new special group coaching wave coming up, so watch out for some new announcements there. The financials, I know this is a big pain point for many of you, and I get a lot of questions. People feel super excited about the business case and the new idea, but then you have to also translate it into numbers, right? Because when you go to your investor or decision maker or corporate project sponsor or executive sponsor, they definitely will tell you, show me the numbers, right? They love great ideas, but you also have to be able to back it up with the numbers, and commit to something that you are about to do. So let's dive into the details. Just as a very small recap from one of the earlier webinars, I showed this basic outline for a business case, which you can use to work along. And there's actually a version in the online course with a much more detailed walkthrough of the entire process. So because I noticed that it's sometimes difficult to find your way, and it's not like very linear that you write it from top to bottom down, but it's kind of an iterative process. But today we talk about the financial plan. Now, the key thing to remember here, this is really the centerpiece of the entire business case and the pitch. Sooner or later, you will come to that point, and typically when the investor is asking you, okay, what are you asking for? What do you need the resources for? So how are you going to spend the resource or the money? And what should I expect as a return? And there is nothing more embarrassing when you have a great presentation in front of you, and then people say, well, we haven't really made up our mind what we need, but do you like the idea? That's not the purpose of the pitch, right? And the business case. You really want to be prepared for that. The other important thing to note is the financial section hangs together with all the other sections. So that's probably why it is so much an area of interest. Now, let's step back for a second and consider the growth cycle here. So I depicted this here with feedback loops. And being a system dynamicist myself, I work a lot with simulation models and feedback loops to train these kind of topics to the audiences. But the financial story really is very much tied to the operational story. And this determines your ability to execute. And of course, the whole idea is that you basically sell something to drive revenue, and revenue minus cost gives you the profit, which you then can spend on people. The more people you have, unfortunately, the higher your burn rate. So that's reducing your cost, of course. But people also give you an ability to execute, for example, into R&D, sales, and other areas, which I'm not showing here. For example, customer success is a key topic right now, especially for onboarding clients on software as a service platforms and other forms of businesses and business models. But also you can, of course, use the profits in order to spend on marketing, which gives you better sales. Why this loop, the blue loop? Well, if you can increase the competitiveness of your product, then with R&D spending and development, then the sales team has it much easier to drive sales, and more sales relates in revenue. So this is the feedback loop, and that's why I say the financial picture of it. So if you just consider the cost, profit, revenue equation here, of course, is embedded in the whole way of doing things. Now, why am I bringing this picture? Now, when I looked at the startups, across all the startups, and we looked at the failure modes, first of all, what are people struggling with, and why are projects failing? And this is, by the way, mirrored in the corporate world with the innovation projects there, with the digital transformation projects. And what we find is actually very interesting. Most of the people and the projects are struggling with one way or another with product adoption. It could be, misjudging the addressable market, or how to get access to the market, how to win the first clients, how to sustain the growth, or how to accelerate, etc., etc. So many topics there, and I expand on that in the other briefing series in much detail. But the point here is that it's really less about funding and the technology. Now, you could make the case that, going back here, the team is, of course, the centerpiece, because with the right team, you can drive a great product, win clients, get the funding, and get the technology right. Yeah, that's, of course, the key, and having the right people on board is the case. But at the end of the day, downstream, then it really matters if you can win clients for your product and your value proposition. Okay, and that's why I'm saying this is so much tied into the whole picture, right? So that's why these two hang together, the product adoption and fueling the growth cycle. So never lose sight of one or the other. And also, and that will bring us to further episodes down the road here, we really need to dive into the adoption dynamics. In every case that I see, I actually ask more questions about product adoption than any other area, right? So I'm not so much concerned that people don't get the technology right or other areas. That's usually not the case. But really, if they understand the dynamics of product adoption and market changes over time, that's key. And for you as the presenter, your credibility is on the line, of course. And your credibility increases when you really understand your adoption story and you can drive the evidence. So if you do the forecasting approximately right, you validate your assumptions, you create the evidence, then you grow and retain your customer base. That's what I mean by your adoption story. And as you can see, that hangs together, of course, with your financial picture. Now, if you don't get this right, then you don't even have to worry about a polished financial story. Okay, so that would be my number one answer here in this whole thing. Then, of course, you need to understand the drivers of adoption and retention. We're not going to cover that in this episode, so that will be for other opportunities, of course. Now, the important tables and charts. Let's get a little bit more tactical here, right? So what you want to include is this set of key things here, which I usually recommend. So it doesn't have to be an accounting exercise, but a profit and loss statement, or in the case of a corporate venture, a corporate project, a project P&L, right? I want to spend a little bit more time on that in a separate class, but I just want to mention this and put this bug into your ear right now for those who are working in the corporate area, because you don't write the whole, and you don't manage the whole P&L usually for an entire maybe division or the whole company. So you have to figure out how to fit in your project into that and how to show what the implications are. Then, of course, the implications on the balance sheet, cash flow, customer base, the B2B partner channels and the entire ecosystem. And of course, your staffing is key. And then your assumptions about market growth, and finally your sales win and pipeline. Now, I do recommend that this is being detailed, let's say, for the first year in a month-by-month fashion, but you also have a longer planning horizon. Typically, this is in the range of 1 to 3 years or 1 to 5 years. It really depends on the kind of industry and the solution that you have. And there's some industry where you would not even go beyond a year or two, because things change so dramatically, so quickly, and so fundamentally that it would be absurd to have a 3-year planning horizon. But I think it's good to have a vision of where you want to take it. And there's nothing wrong with, let's say, failing and not meeting exactly the right targets, right? But the key point is to learn something from it, of course. Then every business case in the financial section it really needs to hang together, and the numbers need to tie and match. So make sure that you capture the important inputs. The customer base, I cannot emphasize that highly enough. In 8 out of 10 cases I see, I always read that there are new customers coming in and the customer base is growing. Most cases actually forget to include the lost customers or the churn rate. That's a big mistake. And it's also a matter of credibility, right? Because everybody knows that, you know, if you have, let's say, even a very low churn rate of, let's say, about 1% or so, that could add up to quite a substantial number of customers that you are losing over the year. That's okay, but you just have to factor it in and deal with it. Then articulate also the order volume and the deal size. Super important, because that determines, of course, the revenues that you will get in. right? And the pricing, of course, is a key point. You may, if you're starting, let's say, the business or the venture early, you may want to give more discounts and then ratchet up the prices later on. So articulate that very carefully. And of course, the staffing levels. In terms of the cost elements, what we typically see and want to see is by line of business and function, broken down into research and development, sales and marketing, service support. Field service I would break out separately for various reasons. And typically the field service organization works differently. It's based on utilization and bill rate, versus the service and support is usually a matter of the volume that you bring into the business. And then your cost, of course, for operations, general and administration. And you would add to that your marketing cost, which is a significant element, or should be a significant element if your solution is not selling like crazy by itself, which usually is not the case. IT cost and, of course, administration cost. And for those who have, let's say, larger business and office space, etc., you also need to factor in, of course, your fixed costs that you have. Now, in all aspects, it is usually better to be approximately right than perfectly wrong. And what I mean by that is, I see sometimes cases and proposals which call out, okay, by month 18, we're going to have a 17.3% EBITDA margin, whatever, right? Now, nobody can really say that, but if you can say, okay, our EBITDA would be in the range of 15 to maybe as high as 22%, that gives me a better feeling and a range that I can work with, of course. And it tells me that you have probably done some sensitivity analysis. Now, key performance indicators, make sure to have a good balance between the financial and non-financial or more operative parameters. This ties back to the earlier discussion that I brought up here. But on the financial side, of course, you want to show your revenue, cost, and EBITDA and profitability, but also your contribution to the revenue of the business and the profitability, and your return on investment or multiple, especially if you talk to potential investors, right? They want to know by what time frame and in what order of magnitude should they expect a return and recycle their money from the investment, right? And then, of course, there are 2, 3, 4 ways to show with numbers if it's a good or not so good investment. One is the net present value calculation, and the other one is the internal rate of return, which gives you a good indicator if it's a prudent investment to make in this project, right? Now, we're not going to do into the financials here in this short webinar, but I can explain this, of course, in the more detailed course. Now, on the operative side, you do want to make sure that you cover all the basics for, let's say, for example, for your marketing and sales activities, the key performance indicators there. But also productivity measures, right? You need to make an assumption, for example, how many customers per person day you can cover, or what is the revenue per salesperson per month, right? So these are important input parameters. And sales cycle times, deal size, win-loss ratios, and the probability of a loss, and the time of risk exposure, etc. Also, what's more and more interesting, of course, for a lot of businesses, especially in the software as a service world, is metrics like the percentage of monthly active users or daily active users. So you see that a lot because there's a certain dynamic associated with that, and you really need to understand that. Another interesting KPI, which I'm not listing here, is what we call the win-back period. So let's say you know that you're spending 500 monetary units, whatever it is, dollar, euro, Swiss franc, whatever, on a customer, right? And the question is, how long would it take to recover these kind of costs, the 500, right? If you can recover that within the first month, that's great, right? But if it takes a year, then that gives you a little bit more of a sense for the risk exposure here, because a lot of things can happen in the course of the year, right? And of course, the sooner you can recover the cost for a customer, and the sooner a customer is becoming profitable, the more you can spend on marketing and on other activities to drive further growth. Now, here's one way to show things how they could look like on your management summary. In the upper left-hand quadrant, you show a picture of your customer base in the way that you have a worst case or best case scenario, and let's say you are here somewhere in year 2, so you believe that it's going to be somewhere in this range. Also, the customer feedback will be important. I would make it simply simple and show it in favorable and unfavorable. And if it's to a large degree unfavorable, then make sure you have a backup slide that shows what your improvement projects are to bring this down, right? Now, this is a very special topic. I might actually spend a little bit more time on this whole area, because it's an increasingly important topic as the world is moving more into a service-oriented business. So when you run a software as a service organization, it's much more important to pay attention to quality, customer feedback, customer satisfaction and retention, and these kind of metrics. So I'd be happy to walk you through a more systematic framework and how to look at this. And now going more to the financial section here, on the upper right-hand quadrant here, where we could show the sales and marketing metrics for year 1, the current year to date, current year forecast, and let's say the 3-year forecast, so to give a sense on how you're tracking along the way. And there you have the key metrics, average revenue per user, monthly recurring revenue, customer acquisition cost, sales, so the unit sales, the churn, etc. You could list here lifetime values and these kind of things. It really depends on what is the focus area and what is the key unit of attention and focus and measurement here. And then on the financial side, you in pretty much the same format, you can show, for example, the revenue that you have accomplished, let's say, or what is in the year 1. Let's say you are in year 2. What is the actual year to date? What is the profitability or the EBITDA, etc. Now, the financial plan, and don't get scared at this point in time, it would look fairly complex, but it's not so complex. So here, let's talk first here on this left-hand side. So first we would factor in our revenue and revenue growth, then the cost of goods or services. So that's basically all the cost elements that we need to deliver the service that need to be accounted for. Could be people, server, bandwidth, whatever. So it's directly attributed to the product and the unit of revenue, of course. And then that would give us the growth margin and also a percentage for that. And then of course, the cost elements do need include the management, sales, marketing, R&D, etc. The reason why I like these to be broken out and shown the year over year is then I can do a calculation of what is, for example, the cost of R&D as a percentage of the revenue, right? Which could be a measure of your, let's say, your delivery capability, or for example the cost of customer service and support as a percentage of revenue gives you a sense of the, let's say, the quality and the effort that you need to bring in order to retain and maintain the customer base. And then it leads all together to the earnings before interest and tax, depreciation and amortization. And then it could give you also some sense of a funding here. Now, what is important here on the time axis is to clearly show what have you done last year, or the previous year, where do you stand year to date right now, and what is your forecast for the next year. And this area in the year one, I would make sure that you can expand also in your spreadsheet and show it on a month by month basis, so that I can get a sense of how you're tracking, if the forecast or the plan is front loaded or has a hockey stick later in the year, and these kind of things, right? And now, of course, on the cost side, what you do want to show here, so this is basically this section here comes from this area, and then you need to break it down, and you can populate that by articulating your staff, your cost per head by the different functions, split that between your fully employed people or permanent employed people, and temporary staff or outsourced capacity that you might have in some period of time, and multiply that with the costs per head, and then you can get this table here. So it's not rocket science, and that is just to show you one drill down and how to construct these kind of tables, right? Now the details, as I mentioned before, you will learn in the step-by-step group coaching class that we're offering online and on-site. Now, some do's and don'ts are based on some of the experiences that I had in the past, both as the presenter, but also more and more as the reviewer of these proposals and the decision maker, right? I gave you some tips already along the way, but let me recap some of the important ones here as well. Make sure that you have a coherent Excel sheet. So what I mean by that is, if you have to change numbers on the fly, then you should not have to redo all the formulas. So make sure it hangs together, and that is also a good way to make sure that the numbers actually add up at the end. Then it's better to show the ranges of potential outcomes. What I do recommend is to do a sensitivity analysis, and I can show some of the examples. Actually, I did in earlier versions of the webinar here as well. Important really to document the assumptions and validate and revise them as you move forward, but also do reality checks and do pay attention to the staff growth rates, especially when you are working in let's say intellectual property driven businesses or software businesses. So they basically scale in terms of the costs with the number of people that you bring in, and so you have to pay attention, because that determines your impact on the burn rate that you have, so how much money you spend on a month by month basis. I really don't like to see hockey stick forecasts which are, let's say, taken out of the blue. So make sure that you have your assumptions worked out, why you think that is the case, and make sure, also I should mention here, make sure you understand the dynamics of viral adoption and accelerating growth. 9 out of 10 people really don't get it. There is a blog post that I wrote about it, also on LinkedIn. It's called Hockey Stick Confessions. And it's based on a number of workshops and also a field study that we did some time ago. And it showed that people really struggle with understanding the dynamics of accelerating growth. And why that is the case, I am explaining in some other fashion here as well. Don't forget to factor in churn and delays, especially when it comes to B2B and enterprise sales. That is typically a very long, tedious sales cycle, so you have to be prepared for that, right? And don't underestimate the increasing marginal cost in maturing, saturating markets. What I mean by that is, as you move along and there are fewer and fewer customers available, it will be harder and more expensive to win them. So don't assume that your customer acquisition cost is necessarily going down because you learn how to win customers. It could actually go up over time. And then you need to understand the movements in the market, for example, based on demographic change. Also, there's a blog post about this, which illustrates how a change in demographic composition of the cohorts in your market can lead to potentially false assumption how the market is moving, right? So you really need to understand that. And I do hope that everybody has implemented the analytics, at least on your website, to understand where the people are coming from. And also, people love these four-quadrant charts, right, which were populated by some industry advisory group, and everybody believes they are in the upper right-hand corner of the quadrant chart. I'm not really sure that is useful. I think it's better to explain why your proposition is better and how your benefits proposition is really unique. Everything else, all the other good news, I will eventually read on the profit and loss statement. Now, again, I showed this in an earlier version. Here's the risk and the return profile of a project, and what I want to see as an investor are these things, right? So what is the order of magnitude of the risk, right? So how much am I risking at what point in time? What is the probability of a return versus a loss, or a success versus a complete failure of the project? And what should I expect as a return and a contribution? And what are the drivers of this risk? And these are important considerations because, you know, as an investor, I talk to many investors who have great funnels, right? So they see, let's say, 1,000 proposals, and they take 5 to 10. So you really have to provide a better story that gives the investor a better feeling why your project has less risk or a better managed risk than the other guys, and why you believe that the chances of driving a positive return is much higher than the other guys, right? So again, this is something that I highly recommend to dive into more detail. And if you don't know how to do this, then call us for help and we'll get it done for you. Reality checks. Famous topic, growth rates. I talked about this just before on the other session, but again, I want to emphasize it. This is typically what we see as a wish, what people would like to have in terms of their business development. Accelerating growth, right? And doubling the installed base every now and then. Now, if you do the math on this chart here, you would find that it would be approximately every 9 months to double the installed base of your customers. That's quite an aggressive goal. I'm not saying that's right or wrong, right? Could be even 5 months, but the question is really, can you deliver that, right? It's easy to draw a chart like this, but if you do the simple reality checks on your spreadsheet, you may find that, okay, that's maybe a little bit aggressive. So let's play it a little bit safer here and under promise and over deliver. Because if you set this expectation and let's say you start out here with 50 and in year 2 you're not hitting not even 100 and not even 150 in year 3, then it is impacting your credibility. And of course, then the chances that you get more investments are really low, right? Okay, so yes, before we go into the Q&A, here's our contact information. If you have, let's say, significant projects that you would like to get a second opinion on or get your team trained, that's how to reach us. Replay will be available on YouTube, and a detailed version of this whole talk is available in the briefing centers and in the training rooms. And feel free to also leave comments and questions in the Facebook group, or it's actually a page called Shape Growth. All right, and here we go for the Q&A. Actually, I received a couple of questions. I usually ask people to fill out a survey before they join the webinar. So I usually take a couple of questions from that first, and then we'll open up to some live questions here. So feel free to put the live questions into your into the chat box here in the webinar, and I'll pick them up as we go. The first question was, okay, how long does it take to put such a financial plan together? What should we plan for? Well, it really depends on how good you are and how fluent you are in the financials. But I would say assume that you cannot do it in an afternoon, right? So it's an iterative process. It will take some time because it also hangs together with your business story, with your product. And if you're not sure how to do it, and if you get lost, I think don't hesitate to call in a coach or a consultant or advisor, right? I think it's really important to come forward with a solid plan. Question was, what do you see as the biggest problems? It was a question for me. Well, as I explained, there are several problems here. I think generally in terms of financial planning, I see that most plans are a little bit too optimistic. So it's better to be more conservative and be aware of the risk. I'm not saying that you shouldn't take on the risk. Of course, it's good to take on informed risks, but make sure that you can back up what you're planning to do with information and validated information, right? There's a step-by-step process that I explained in a different occasion in how to take the risk out of your project and out of the equation. So that's something I would recommend. Yeah, so there's one comment here. Live, yes, can we train our whole team on that? You can actually, you can do it either as a self-paced learning in the briefing center, or would be happy to also do a training for you specifically for the organization. Technical question, what do you prefer in terms of the KPIs, NPV, IRR, etc.? Really, I would prefer first, if somebody is showing the raw numbers of how they came to their conclusion. I think the NPV or IRR is just an expression then of that. Now there are different, let's say, approaches how to look at this. One is with the classical financial metrics, and some people say that they have a little bit of a bias. And so they maybe even underestimate the opportunity that is in a project. A different school of thought would be to think of it like a real option that you can execute, and think of it more as a set of risks that you have to manage. And that's why personally I'm gravitating more towards this risk approach, a risk-driven approach, where you can de-risk the project step by step. I think that gives you a better sense of where the project is going, and you might be surprised actually what opportunities you find in order to unleash the growth there. Question here is, who should do the financial planning if you don't have a CFO? Well, I would say it's a good exercise to do as a team. Because it brings people together, and if everybody understands the numbers, I think it also is strengthening the accountability and the commitment, because everybody with their activities are contributing to the overall picture, right? And it's important for everybody to understand where you stand, why you stand there, and what you can do, sometimes even to get out of the jam and move forward, right? So make sure that I would actually speak openly about the numbers, and make sure you explain that thoroughly, how they hang together. Now, not everybody is a chief financial officer. Not everybody is fluent in accounting or knows how to put these together, right? There's let's say, ways to do this more or less granular. If you had accounting classes, then it's probably easier for you, but you don't necessarily have to be an accountant to put together your financial plan, right? Question was, are there tools that can do this for you? Yeah, there are probably a lot of tools, and I highly recommend, if you advancing in your business, to check out the various tools that you can find. Happy to review some of the tools here on the webinar with you or for you. But I would actually say in the early phase of project planning, you really should do this on a spreadsheet, because it provides clarity, transparency. You can move the numbers around and change them based on the feedback that you get from the market and the project. So I think that's what you should be doing. Another technical question about project management. A lot of tools questions here today. So what to use for project management? I mean, really, the high-level plan you can actually also do on a spreadsheet or on a PowerPoint chart, etc. Right? But if you really want to manage the dependencies, I think there are so many great tools out there. You can use, let's say, Project, for example, Microsoft Project, or other web-based services. I've seen people hosting their own project server, etc. It really depends on the kind of project that you have. I think what is a good practice is to use a tool that is helping you also to manage the task-driven approaches and understand your project dynamics, your burn down charts, etc. That's super important, because usually the product development is eating a big chunk usually of the cost basis, especially at the beginning, right? There's a quite interesting question here about pricing, how to set price. Now, of course, I cannot overemphasize pricing is really an important point. It's probably your number one growth lever and growth initiative. So setting the price correctly, I think, will help you tremendously. There are different ways to do that. Of course, you can do it by rule of thumb. You can do a cost-plus driven approach, a value-driven approach. We might actually talk a little bit more about something that I really like as a planning method, called the conjoint analysis, which is a little bit more of a more sophisticated statistical procedure, but it really gives you two things. One is an optimal combination of product features and packages, and also the price. And price in terms of how should I set the price in order to capture a good chunk of the market, right? So that is usually the key consideration here. Now, what you can do, if let's say you're in an early stage, you can test the market pricing in different ways, because ultimately what you want to understand and you want to get a sense of is your price response curve, what the economics people call the price response curve, right? So what portion of the market can I capture with a certain price relative to another price, right? It's actually a great topic. We might bring that up as one of the next ones here. And of course, pricing power is really key, because price has a big impact on also the entire operational piece. So everything from, of course, profitability and revenue, but also an impact on churn, right? So make sure that you spend sufficient attention to the price setting here. And price is also related to, let's say, your brand and brand perception and so on. Super important topic. Actually, thanks for bringing that up. I think we will do a couple of sessions on pricing, and I will be happy to also invite some of my best network contacts to talk specifically about what the successful practices would look like in the industry. All right, so I think that's it for today. We went a little bit over time here with a lot of questions. I try to keep it somewhere between 30 to 45 minutes on the webinar. Again, feel free to use the Facebook groups. And until then, I wish you good luck with your projects. And obviously, I'm very happy to hear from you. Don't forget to like, share, rate, and join the YouTube channel, so then you can get the latest information. Having said that, that's it for today. And now I wish you good luck and happy planning and happy pitching with your projects. Bye-bye.